Okay, so today is the 10th day of November 2021. 10th day of November 2021, and we are continuing our lectures on Nigerian company law. Our focus today is on financial statements and audit in outline, after which we will look at dividends. And then we will adjourn. Learning outcomes for financial statements and audit. Learning outcomes. What are you expected to know at the end of this topic? Number one, who has the duty? So you may want to write down. Who has the duty to prepare financial statements? What are the documents to be contained, or what are the documents that comprise the financial statements of a company? But I thought this thing should be able to be tighter. What are the documents that comprise the financial statements of a company? I want to believe that it shouldn't be pending like this, but we can look at it next time, later. Don't worry, just go. We'll go. What are the documents? When we say a company's financial statements, if I now ask my son Callistus, what are a company's financial statements? He should be able to let me know at the end of this course, this topic. What are the documents that comprise of the company's financial statements? When can a company be allowed to present modified financial statements? When will a company be allowed to present modified financial statements? Another thing you should know at the end of this topic is, what is a small company? What is a small company? How many have you written so far? 4. Another thing you should know is, what are some of the contents of a director's report? What is a director's report, and what are some of its contents? I think if we know that, we have tried. So basically, then now when we come to audit, again, you want to know, what should you know at the end of this class? What are the qualifications what qualifications should a person have before he can be appointed as an auditor of a company? Basically, qualifications. You should also know who is disqualified from being appointed to audit a company. Who is disqualified from being appointed to audit a company? Who appoints the auditors of the company? Who has responsibility to appoint the auditors of the company? Thank you, Lord. You should also be able to know the procedure for removing the auditor of the company. What is the procedure? How do we remove him? Then you should also know his duties. What are the duties of the auditor of the company? Okay, so with that, we should be able to run through, after which we should now enter into dividends. Thank you. Just a second. Okay, so basically you find these topics in chapters 14, 15, and 16. Chapters 14, 15, and 16 of Kama. 14, 15, and 16 of Kama. Thank you. Okay, so I'll just jump in. First of all, as by way of introduction, we know that companies are or comprise of an association of persons, presumably, while discounting the fact that we now have single-member companies. But at the classical, traditional level, a company comprises of two or more persons who have invested either their funds, their time, their energy, or whatever. And these persons are the core stakeholders of the company. Yes, we can still have other stakeholders like consumers, customers, creditors, as the case may be, but the primary stakeholders of the company are the members. The members. My Audit brother, I hope you are with us. Good. And the company again differs from the partnership entity in that these members presumably are not also involved in management. For the partnership entity, we know that membership and ownership is fused into the same persons. And if membership and ownership is fused, then the burden for accountability ought not to be so strong. You are a member, you are also a manager of the entity. And so you ought to know what is happening. And so that explains why partnership law and company law does not extensively impose accountability responsibilities on such entities. Are you with me? Even though there's still provision for some level of accountability, it is not very extensive. When we come to the company, on the other hand, because company law presumes that the managers, called directors in this case, and the members are separate, and classic corporate law theory says that it is these members who have invested their funds for the advancement of this entity. Then the persons who manage the entity should be, from time to time, ready to render accounts to them. So there should be an adequate and robust accountability framework so that these persons who have plowed in their funds will, number one, not be defrauded. Number two, we'll be able to have a firm grasp in terms of knowledge of what is going on in that company. Are you with me? And so it is on that premise that Section 374 of CAMA now provides or imposes upon companies in general. You will discover as we continue that this general burden has some exceptions with respect to small companies and companies that have not yet started business. But the general duty is that companies have a burden or an obligation to keep first accounting records. First, accounting records. Accounting records sufficient to show and explain their transactions and which disclose with reasonable accuracy at any time their financial positions. So that is the first thing we need to know, is that company law imposes upon all companies, you must keep accounting records that are sufficient to show and explain your transactions and to disclose with reasonable accuracy at any time your financial position. This duty is imposed upon the directors. It's not imposed upon the accountants. Please note, it is imposed not on the secretary, nor on the internal auditor, managers, but it is imposed upon the directors, who are to ensure that these statements comply with the provisions of CAMA with respect to form and with respect to content. With respect to form and with respect to content. Can we continue? Furthermore, still in the same vein, these records are to contain, first of all, details of day-to-day entries of all monies received and expended. So any money you spend, write it down. Every kobo you receive, write it down, because you're not dealing with a company. They should also contain details with respect to the assets and liabilities of the company. Assets and liabilities. And for a company that is involved in dealing with goods, they shall additionally contain statements of stocks held by such companies at the end of each financial year. Other details include all goods sold and purchased, as well as details of buyers and sellers in sufficient detail to enable adequate identification, unless where such goods are sold by way of ordinary retail trade. So if you are doing basic retailing, every day people just come and buy, you cannot expect us to keep all those details of everybody who comes here to buy biscuit, chim and granite. No. But apart from such ordinary retail, you are meant to give us details even of all your buyers and details of all your sellers. And these records are to be kept at the company's registered office and be open for inspection. So the next thing is location. First of all, there's a duty to prepare these records. Now, Kama now tells us what these records should contain and tells us that they should be kept at your registered office and be open for inspection by officers. I felt that is curious why they should be open for inspection by officers but not to members. But I will come and say they should be open for inspection by officers of the company at all times, and they should be preserved for a minimum period of 6 years. Electronic copies are also mandated to be kept. Electronic copies. So the company also is expected to now keep electronic copies as well of all of these documents. Are you with me so far? Just a second. And as is often the case, there are, penalties, blah, 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 fines and sanctions where the company is unable to, or where there's default in preparing these documents. Just a second. Okay, so going further, CAMA also imposes upon companies a duty to now prepare financial statements. Financial statements. And most of these statements are prepared with the aid of these accounting records. I will now run through some of these statements. The statements are actually documents that the company is mandated to prepare. There are a number of documents we expect you to have, and these documents collectively comprise of the company's financial statements. I will run through them. Number one, the company's accounting policies. Accounting policies. Number two, its balance sheet as at the last day of the year. Balance sheet designed to give a true and fair view of the state of the affairs of the company, blah, blah, blah. Balance sheet as at the last day of the year. The third one is a profit and loss account or an income and expenditure account for the year. I believe you've come across this in accounts. I'll run through them again. Number one, the company's accounting policies. Two, the balance sheet. Balance sheet as at the last day of the year, designed to give a true and fair view of the state of affairs of the company. The next one is a profit and loss account or an income and expenditure account for the year. The next one, notes on the accounts. Notes on the accounts. The next one, an auditor's report. An auditor's report. The director's report. A statement of the source and application of funds. A statement of the source and application of funds. Changes in equity. I don't know what that means. I will find out. Welcome, madam. Changes in equity. Coming later. I have your father's phone number. Don't forget. Changes in equity. A value-added statement for the year. A value-added statement for the year. And a 5-year financial summary. And a 5-year financial summary in the case of a holding company. If a 5-year financial summary, and in the case of a holding company, group financial statements are also required. Thank you, Lord. So these are the basic statements I want you to note. We don't need to, like I said, we are going through it in outline. You are, as a company, the directors are required to prepare these statements. You can see that they are quite elaborate. Accounting policies, balance sheet, profit and loss, notes on account, auditor's report, director's report, statement of the source and application of funds, changes in equity, whatever that means, I'll find out. A value-added statement for the year, a 5-year financial summary, and in the case of a holding company, group financial statements. Like I said, the whole idea is to ensure that anybody who probably wants to have dealings with the company should be able to have a first-hand grasp of their financial situation and beyond that, their activities. But not just persons who want to have dealings, but even the members of the company, like I said, who presumably have invested funds, should also be able to know what has happened within the past 1 year. What have we made profits? Have we made gains? And all that. And you know, it is from these accounts, when they are published by the company, and if the company is traded on the stock exchanges, when these accounts are published, that will now determine if they have made profits or not. And if the company has made profit, the value of its shares is likely to go high. And if it has not made profits, the value of its shares are likely to go down. Now, companies could also be in a group. A group of company comprises of a parent company and subsidiaries. A parent company, which you may also call a holding company, and subsidiaries. Are you with me? Are you with me?
Yes, sir.
And in subsidiaries, there are different ways of looking at it. A company can be a wholly owned subsidiary of another company, or a company can be a subsidiary of another company. So, for example, I like looking at companies in a group like Dangote now is a group. We have Dangote Cement and Dangote Sugar and all that. Now we have the parent company, which now has these subsidiaries. If you are able to exercise control over the other companies and you're a majority shareholder, then we could say that that company is your subsidiary. But if you are the only shareholder in this company, then we say that company is wholly owned. You know, so for example, Dangote refinery now, NNPC is trying to buy into it, buying 20% of it. If NNPC succeeds in doing that, then we will not say Dangote refinery is a wholly owned subsidiary of the Dangote group itself, the Dangote and the parent company. Are you with me? Yes, because it doesn't own all of the shares. So let's just try and look at what Kama says about defining subsidiaries and holding companies. So so company A, you can write down company A is a subsidiary of company B if it If hello? Okay, sorry. Company A is a subsidiary of Company B. Number one, if Company B is its member, first criteria, if Company B is its member, number two, and controls the composition of its board. Of directors. Can we continue? You see order in section 381 after. Number two, Company A will also be a subsidiary of Company B if Company B holds more than half of its equity share capital in the nominal value. Number two, Company A will also be a subsidiary of Company B if Company B holds more than half of its equity share capital in the nominal value. Callistus, you are not writing. You don't have pen, I can give you pen. Can we continue? Thirdly, Company A will be a subsidiary of Company B if it is a subsidiary of Company B subsidiary. Maybe should I take it again?
Yes.
Number three, Company A will be a subsidiary of Company B if it is a subsidiary of Company B subsidiary. The second one, I will take it again. Or if Company B holds more than half of its equity share capital in the nominal value. More than half of its equity share capital in the nominal value. Are you with me, Aboye?
Yes.
If I'm setting an exam, for example, on this kind of question, it will not be straightforward. That is why you have to apply yourself. First of all, you have to have a grasp of the law. No serious lecturer will ask you, what is a company subsidiary? Because, of course, if you have read, you should know it. But I will try and twist it so that you have to think. That is the challenge I'm having with my second son now. If you tell him 25 plus 30, he will give you the answer. Put it in a problem question, he's knocked off. So that thing, you know it. But you have to now know how to apply. I went to filling station and I bought 30 liters of petroleum. And I spent 2,000 naira. How much is 1 liter? You have knocked him off. But if you now ask him, 2,000 divided by 30, he will just and that is the problem a number of you are still having. So, for example, I'm trying to set a question around this. I can say, Company ABC has a share capital of, let's say, 100,000 naira, divided into 70,000 preference shares and 30,000 ordinary shares. PIMO has 90% of the preference shares, but she has 10% of the ordinary shares. Is the company is a subsidiary? Definitely not, because the definition here says equity share capital. So you will now have to think and know that preference share is not an equity share. And in defining a company as being a subsidiary of another, the second leg of the definition is saying, the first leg basically looks at one, membership and the ability to appoint the directors. Is that also? Second leg says equity control. So you have over 50% of the equity. Then that company is your subsidiary. Then the third leg is now looking at your relationship with the relationship of three companies. So we have a Heritage Bank, we have First Bank, and we have UBA. UBA does not have any direct link. Please listen. UBA does not have any direct link with Heritage Bank. But it has a link with, where's that writing material? So we have Heritage Bank, HB. We have UBA. Then we have First Bank, First FBN. These two companies have no direct nexus. Yet company law is saying that in certain instances, this company can be a subsidiary of this company. If First Bank is a subsidiary of UBA, and UBA is a subsidiary of Heritage Bank, indirectly and automatically, First Bank will be said to be a subsidiary of Heritage Bank. Good people. And how do we determine this subsidiary? I've said again, it can be determined, one, with respect to board appointments. Board appointments. The moment you have the right to control the appointment of the directors, and you are a member. So, I could ask you a question in the exam. That is why you have to know the law. When you know the law, application becomes easy. My lecturer in the university, in law school, Professor Paul Idonike, used to tell us that if you know the law, where we won't pass. When you know the law, your hands is just like a goalkeeper whose hands are anywhere they play, you catch. So I could set a question that Heritage Bank is a creditor to First Bank. Is a creditor to UBA, sorry. And by virtue of section 46, subsection 3, the memorandum has given to it the power to appoint the directors of this company. But it is not a shareholder in the company. If it is not a shareholder, then that company is not a subsidiary. Two factors. Number one, you must have at least a share in this company, because it is shareholding that makes you a member. Is that also? Yeah, particularly for share capital companies. So number one, you must have at least a share. Number two, you have the power to control the appointment of the board. Then that company is your subsidiary. And number two, like I said, if you hold half of the equity share half or more. And thirdly, if company A is a subsidiary, if First Bank is a subsidiary of UBA, automatically First Bank is a subsidiary of this. Are there questions? Is it clear? Is it on Timmy? This is my daughter. Is it clear? Is it clear? What is not clear? Tell me, let me explain. Jennifer, is it clear? Aiba Tari, is it clear? Tari? Yes, let me hear you. I'll take it again. Yes. How are you?
I'm having an English language problem.
Okay.
Is there any synonym for subsidiary?
Subsidiary, basically, thank you. Subsidiary simply means something that is subjected, something that is under your control. Subsidiary, something that basically is like an extension of yourself, and something that you have spawned, you have given birth to, in another sense. Yes, sir, let us hear you.
Most of the time, but intentionally managing to survive.
Okay.
And most times they are still out by bigger banks.
Okay.
But still bearing their names. So they fall into this.
Yes, it will depend. Its question is, we have had a number of banks that are having issues but have been bailed by bigger banks. Does it mean that they have become subsidiaries? Yes and no. If you are a creditor A creditor can have extensive control over a company by virtue of the fact that he has come to bail you out. But if he doesn't have shares in that company, then within the definition of karma, of course, we all know that you can say it's a subsidiary. But technically speaking, within the confines of the law, it will not be a subsidiary. So two major criteria are given to us. Number one, you are a member, you control the board. Number two, even if you don't control the board, you have at least 50% of the equity. So these are the two major planks. Then we have the third plank, subsidiary. If you are a subsidiary of this, automatically you are a subsidiary of that company. So if UBA is a subsidiary of Heritage Bank and First Bank is a subsidiary of UBA, it now means that First Bank will be beholden not just to this company, but also to this other company. So I'll take it again. For purposes of effectiveness, sometimes, or corporate organization, it may be wise and necessary for an entrepreneur to carry out his business through several companies. It may not be tidy or decent for an entrepreneur to carry out all of his businesses under one corporate platform. We know today that by virtue of the provisions of company law, the ultra vires, doctrine is almost gone. And so yes, you can incorporate a company, and through that company, you can be involved in 1, 2, 3, 4, 5, 6, 7 different unrelated businesses. Yes, you can. But like I said, for purposes of effectiveness and tidiness, and even to limit your liability, it may be good to have subsidiaries. Each of these subsidiaries are separate legal entities. If you recall from our first semester, when we looked at the corporate personality, limited liability, and all that. So each of these subsidiaries are separate legal entities. They may be owned by the same group of shareholders, but company law regards them as being separate from their owners. And if they are separate from their owners, it means that they are separate from one another. That's the first thing we need to remember. And so it means that if I talked about, if you looked at when we were looking at lifting the veil of incorporation, I gave you a number of articles. A company, an entrepreneur who wants to invest his business in a very high risk environment may decide to limit his liability by doing so through a separate corporate entity. A separate corporate entity. So we have Shell, SPDC, that has now been allocated an oil block in Bonga, offshore, where the risk may be higher, risk of accident, because now we're talking about offshore. There's an oil spill before you can even get there to clean it. They may not want to carry out that venture through SPDC. And so they now set up SNEPCO, Shell Exploration, blah, 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 to carry out that venture. In so doing, they are also separating themselves. They stand to reap the benefits of that company, but they can also limit their liability. So if SNEPCO, in the course of carrying out its operations, now causes an oil spill like they did in 2011, that released over 40,000 barrels of crude oil, and SNEPCO is unable to satisfy the government as well as the fishermen and the farmers whose lifestyle, sources of living have been affected, you will not be able to proceed against SPDC, because SPDC is a separate legal entity from SNEPCO, not minding the fact that they all belong to the same group. And so, in the course of preparing your financial statements, company law, nonetheless, while recognizing your separateness, still mandates companies that are in a group to prepare what they call group financial statements. Are you with me? Group financial statements. And to prepare that group financial statement, it first of all tells the parent company, which you may want to call the holding company. It tells the parent company to prepare not just a financial statement for itself, but also for its subsidiaries. And so when we looked at the exceptions to the disregarding of the corporate personality of the company, if you recall from first semester, we looked at statutory disregard, and this is one of the exceptions. You recall? Good. We also talked about investigation of companies when you're investigating a company under minority protection and all that. You can also investigate subsidiaries. But we now need to know what is a subsidiary then. And Kama is now first of all giving us 3 major plank of definition. I think it should be very simple enough. That number 1, if you are a share, companies can also be shareholders. So if UBA Nigeria Limited has shares in First Bank, number 1. Number 2, has the capacity to control the appointment of the board of directors of that company can be said to be subsidiary. The second definition, if you hold more than half of the equity share capital in the nominal value and all that. Can we continue, please? So look at section 381. I want you to go back and look at when can we say a person controls the composition of the board of directors? Look it up. Success, look it up. When, write it down, please. When can we say a person or a company controls the composition of the board of another company? The next thing I want to say is like the other side of the coin. What is a holding company? What is a holding company? We have talked about what is a subsidiary. Now, what is a holding company? You can look up. You cannot talk about subsidiary. Whenever I use the word subsidiary, you are now making reference to 2 companies. Whenever we talk about holding company, again, we're talking about 2 companies. So, in relation to that company, I am subsidiary. In relation to this company, I am the holding company. So, it's just the other side of looking at it, that company B, you can write it down now, company B can be said to be the holding company of company A, if company A is its subsidiary. If you are my subsidiary, I am your holding company. Very simple. And like I said, note the difference between subsidiary and wholly owned subsidiary. Secret, what is the difference? Wholly owned. Wholly owned subsidiary, yes. Headman, my brother, when can First Bank say UBA is my wholly owned subsidiary? Wholly is WHOWLY. Yes. Let me hear you, my daughter Titi.
You can say that the wholly owned company if they have 100%.
Yes. Wholly owned subsidiary is a company that you own all the shares, either directly or through nominees. Are you with me? Either directly or through your nominees. So, thank you, Lord, for giving me the best job in the world. Okay. This is the best job in the whole world. Good. So now we have, please listen. We have a UBA PLC. Then we have a First Bank, FBN. So we can say that FBN is a wholly owned subsidiary of UBA if UBA owns all the shares of First Bank, either directly or through nominees. So we can see a case whereby First Bank can be owned by UBA PLC, can own 80% of the shares directly. Then UBA Insurance, which is a subsidiary of UBA PLC, owns the remaining 20%. Or UBA Real Estate. So if you own it either directly or through nominees, then we can say that that company is your wholly owned subsidiary. I think we can now move on with this. So, like I said, companies in the group are mandated to prepare group financial statements. But when will group financial statements be dispensed with? Number one, write it down if it will be impracticable. Impracticable. The latest bride in town. I'm still waiting for my wine from your husband. Oh, I will not allow you to go until I see him. Can we continue? Can we continue?
Yes, sir.
Number one, if it will be what? Impracticable. Number two, of no real value to the members. If it will be of no real value to the members in view of the insignificant amounts involved. To just waste our energy and time to prepare group financial statements of all of our subsidiaries, because they have not even made any, in fact, they have not done any business for the past 20 years. So don't waste our time. Number one, it will be impracticable. Number two, it will be of no real value to the members in view of the insignificant amounts involved. Number three, it will involve undue expense or delay that is out of proportion to the members. Number three, the results will be misleading or harmful to the business of the company or any of the subsidiaries. These are all accounting things. Don't worry, because of our time, let me just rush. You can take it, get the video or the audio. Or where the business of the parent company and that of the subsidiary are so different that they cannot reasonably be treated as a single undertaking. So I want you to note these instances. I may just ask you a straightforward question, because I will definitely ask one straightforward question. Anybody who is reading, if he holds that one, he has got his 17.5. If he holds the CA and he shakes himself, he should not fail this course. Okay, let's move on. Thank you, Lord. Okay, so persons entitled to receive the company's financial statements. Persons entitled, every member basically, every debenture holder. Basically, the members and the debenture holders are entitled to receive these documents. It's an offense not to prepare them. I've already said that, and there are fines imposed. Now, let's talk briefly about the auditor's report. You recall that we said that among the financial statements of the company, one of them is the auditor's report, another one is the director's report. Is that not so?
Yes, sir.
So we'll come to the auditor's report. Let's just talk about the director's report first. You want to see section 385? Again, it's submitted to the members and to Corporate Affairs Commission on an annual basis. It's to give a fair view. Let me just run through because of time. Give a fair view. You have a class by? Good, so I have to rush. Give a fair view of the development of the business as well as those of the subsidiaries during the year and of their position at the end of it. Is to state the amount, if any, recommended for dividends. So if we have recommended dividends to be paid to shareholders, insert it in the director's report. If we have also decided to reserve some of our funds as capital, insert it also in the director's report. State the names of the persons, state the names of the directors of the company, the financial activities of the company, and the subsidiaries, significant changes in those activities, and all that. So these are basically what you will find in the director's report. Are you with me? Then also part 1 of Schedule 4. Part 1 of Schedule 4 of CAMA now contains other things that you may want to find there. Significant asset changes, director's interest in the company's securities, charitable gifts, important events that occurred within the year, gifts and donations, names of the distributors, details with regard to the repurchase acquisition of the company's shares, employee training, health and safety, and all that. So basically, when we when we have a general meeting, what you call the AGM, annual general meeting, we expect the directors to brief us of what has happened within the past 1 year. Are you with me? And that report is what we now refer to as the director's report. It is usually read by the chairman of the company, who addresses the shareholders and then begins to give them a lowdown of the challenges they face. And why are you happy? Why are you happy? Why are you smiling? Give them a lowdown of all that happened within the past 1 year. Another thing I want to point out is that small companies are allowed to present what is referred to as a modified financial statement. Small companies are allowed to modify their financial statements. Are you with me? So for us to first of all know what are the contents of the modified financial statement, we want to first of all know what is a small company, and you see that in section 394. Headman, what is a small company?
Small company it's a one-man company. One-man company.
Who told you so? Who told you so, sir? Is it me?
As a single company.
Who told you that, sir? If you are not sure, say you are not sure, sir. Are you battery? You had A in first semester, so you must justify that your A. You'll be keeping quiet. You come and make A. Justify it. What is a small company? Yes, my son. No idea. Don't worry, I'm here to guide you. Any other person can throw some light. We have been talking about it again and again and again. Small company, they have a number of exemptions. And what are some exemptions you can remember with regards to meetings and all that? What exemptions or reliefs? Yes, my son.
They can have a director, not two directors.
Yes, they must have two directors. Again, what other one? Yes, my son. Okay, let's hear you.
They may not appoint auditors.
Okay. Yes, they have exemptions in that respect in terms of audit requirements. Yes, you want to say something? We talk about them at meetings now, didn't we? Yes, they are not mandated to hold AGMs. What else? What about secretary? Did we talk about them as secretary?
Yes, sir.
What did we say about that? They don't require what? No, that is private company. What did we say about small company with respect to secretary? Somebody should look at section 330 quickly. Did we say anything about that? I think we did. Yes, my dear.
Except in the case of a small company,
Mm-hmm.
every company shall have a secretary.
Yes, good, Clementina. So these are some of the exceptions again that we have been noting, and as you keep looking at the law, you keep on seeing reference to small companies. Is that okay? So what Kama is now saying is that these are small companies, and we should not, impose upon them too much burdens. We should give them a number of reliefs, which we have already outlined brilliantly, that they don't need to have a secretary. If they want to, it's okay. They don't need to have an AGM. If they want to, it's okay. They mustn't have two directors. If they want to, it's okay. And now Kama is also telling us that they don't necessarily have to comply with the elaborate audit requirements imposed upon companies. Again, if they want, it's okay. The other one we're now looking at is that they are allowed to present modified financial statements. Are you with me? So they can, instead of them to have the elaborate financial statements, which we have already looked at, they can modify them. So what then should be the contents of the modified financial statements? You want to look at the 6th schedule, part 1 of the 6th schedule to the Act. Please note it. Be more, note it. Part 1 to the 6th schedule to the Act. Thank you, Lord. But more importantly, we want to look at what qualifies a company to be a a small company. Yeah. So first of all, two things. You can have a small company, you can also have a small group of companies. Remember, companies are allowed to prepare group financial statements. You recall? Subsidiary and holding companies. But the law is now saying that even though you are allowed to prepare or you are mandated to prepare a group financial statement, all the companies in that group may still be small companies. A small bakery business, a small barbering salon, a small hairdressing salon, a small poly business. When you look at everything, it's still a small company. Why should we impose upon them elaborate statutory obligations that were not originally targeted at them? Why shouldn't we give them some leeway, some relief, if you may? So first thing we want to look at is what is a small company. Before we look at it, I want to point out that in determining a small company, is that determination or definition is not a fixed definition. You cannot say this is a small company in perpetuity. A company can be small today and big tomorrow, and small next tomorrow and big the other day. Brilliant, are you with me? Yeah, it's not like private. When you are a private company, you're a private company until you go through a formal process of re-registration. But when we are looking at whether you are small or big, there's nothing like big company anyway. But when we are looking at whether you are small or not small, we are looking at your position within this 1 year, this last financial year. So two things. The first thing we want to look at is that the small company must be a private company. Under CAMA 1990, it must be a private company with a share capital. So it must only be a share capital company. But CAMA 2021 has removed that and is now telling us that a guarantee company or a share capital company can be either small or not small. So first thing is that it must be a private company. Are you with me?
Yes, sir.
Secondly, before we come to that, look at section 394. I want to explain something. A company qualifies as small in relation to its first financial year if the qualifying conditions are met that year. So there are certain conditions that must be met. If those conditions are met, the next thing we'll now look at it. At what year was it met or were they met? If they were met within the window or the bracket stipulated by the law, we can say a company is a small company. And even for subsequent years, a company can be called a small company this year, even if it doesn't meet those conditions, but if last year it met them. So I'm going to explain, just bear with me. So first thing we're looking at is a new company. A company that is just newly incorporated. CAMA says that it will qualify as a small company in relation to its first financial year if it meets the qualifying conditions. Callistus, what are the conditions? Ask me, what are the conditions? The conditions are that, number one, it must be what? A private company. Two, it's turnover. So when we're talking about turnover, now we're looking at your trade. What the money that has entered your hand through your buying and selling. We're not looking at your profits. Brilliant, are you with me? We're not looking at your profits. You can have huge turnover and still have loss. Abadi, am I right? Yes. So we're not looking at profit in defining whether a company is small or not small. We're looking at turnover. So the first thing is that it must be a private company. Success, are you there? The number two is that your turnover doesn't exceed 120 million or such other amount as CAC may determine, because inflation can, so God forbid, so swallow the economy that 120 million has become nothing. As at 1990, CAMA 1990, the amount inserted there was 2 million. So to determine a small company, we use 2 million as turnover. But because they did not have this second provision, empowering the regulator to alter this provision, we had to wait for 30 years to change this. It meant that 2 million as of 2019, which probably has now become like 100,000 naira or less. Oga Miri, you know that the thing that 100,000 naira could have bought in 1990, 2 million naira will not have been able to buy in 2019. Am I right, sir? Yes, so inflation has so swallowed the money. But because there was no flexibility to allow the regulator to alter this provision, it meant that in defining a small company, as at 2019, we still had to use 2 million. To avert that, Kama now says to us, what is a small company? 120 million. But CAC can change it. So if inflation now makes 120 million to become nothing in the next 20 years, CAC can, by regulation, say, from henceforth, a small company is a company whose turnover is 1 billion. So by default now, it is how much? 120 million. Good people, good lecturer. The next thing we now look at in determining if a company is a small company or not is to now look at its assets and, yes, its assets, net assets. You know, when we talk about net assets, net means that you have removed. Is that also? You have cut off the liabilities. Net assets, not just assets, net assets. So the net assets value, when you add everything, is no more than 60 million by default. Again, CAC can increase it. So first, a private company. Second, by default, turnover is 120 million. Thirdly, by default, net asset value is 60 million. Are you with me so far?
Yes, sir.
The next set of conditions, the next two conditions now have to do with the members. First, none of the members must be an alien. So I could set an exam for those who are not attending lectures and who will not still listen to this audio. I could set an exam that we have a company, blah, 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 blah. The net asset is 60 million. The turnover, 120 million. But one of the shareholders is a Lebanese. Ah, this is a small company. If you now miss off. No. Kama says that none of the members must be an alien. Non-Nigerian. It's not a Nigerian. Are you with me?
Sir.
Yes, please.
So then, do I feel able to still follow or not?
Dual citizen. Good question from an intelligent man. If you're a citizen of Nigeria, whether you're a dual citizen, you are not an alien. So if you hold Lebanese citizenship and Nigerian citizenship, you are not an alien. To my mind, you are a Nigerian citizen. And if you're a Yoruba man and you have gone, I know somebody, a relative of mine, whose husband wanted to be a Japanese citizen. He speaks Igbo more than the Igbo people who are in Imo State. So when you see him, you know that this one is a core Igbo man, but he's not a Nigerian. He's Japanese. Because to get Japanese citizenship, you must relinquish every other citizenship. So he denounced Nigeria. So he's in Japan. He has wife here. The wife does not know. He has wife in Imo State. From time to time, he still comes to Nigeria through Ghana. Are you with me? But he's not a Nigerian. So that kind of person now, so if I set an equation like that for you, you should know that that company cannot be a small company. Because that man, even though he has an Igbo name and he speaks Igbo, and he has Igbo children, and he has Igbo wife in Imo State, he's not a Nigerian. So these are some of the nitty-gritties and all that. He has Japanese wife there. He has an Igbo wife here in Imo State. He's managing himself. Yes, let's hear him.
But in Nigeria, the Lebanese and the Indians, they
Yes.
have a way of circumventing.
They are all over the place.
You know, and they use Nigerian fronts to establish small companies. What do you do about that?
Good question from an intelligent elder. What Oga is asking is, what Oga Thomas is saying is that these men, who are not necessarily Nigerians, about this, like this thing has kicked off. They have a way of circumventing the provisions of our law. If they circumvent, it is the role of the investigators and regulators to ascertain and ensure that the spirit and the letter of the law is applied. But what I do know is that some of them have become Nigerian citizens. A number of these Lebanese businessmen have Nigerian citizenship. And there's nothing you can do about it. They are Nigerians. They are. And okay, so that is the next qualification. Then the other one is that, please listen. The other one is that none of the members is a government, government corporation or agency or its nominee. None of the members of this company is a government. So by state government, if it is a member of the company, that company cannot be called a small company. A government corporation like NNPC, or agency or nominee. Once any of that happens, then that definition is off. Lastly, for share capital companies, a company can only be a small company if the directors together hold a minimum of 51% equity share capital. So those are the qualifying conditions. Let's go through them again. Number one, I'll call your name. AB, I always like to call your name. Number one, qualification. Good. My doctor, confidence. Number two.
None of the members to be an
Alien. Good. That my Kolokuma brother. I don't know. Yes, the man near Ibatari. I think you are Kolokuma. Number three.
The net asset must not be more than 60 million.
Excellent. By default. Yes, my child. Number four.
Government should not be part of it.
Yes, government must not be a member, not part of. Government must not be a member. Yes, Clementina.
Its turnover is not more than 120 million or an amount that the regulator may fix from them.
Excellent. Then Zimwa, number 6. Number 6, for share capital company, yes. For share capital company, yes. The directors must hold at least 51%. I've not heard Okobo today. Is he under punishment by any of you? Have you people held a meeting among yourselves and told him, don't talk in class? Okobo, if there's any such punishment, let me know. I will lift it. I will lift that sanction. Okay. So that is the qualifying condition. And what we are trying to say is that in determining a small company, this Kama now stipulates when we can say a company is small and when these qualifications will be met. Please look up. It is possible because we have these variations in trade. This year we may sell 121 million. Next year we sold 119 million. The other year we sold 130 million. Are you with me? Yes. And so if we don't have some flexibility in defining what is a small company, then we may mess up the organizational, the financial record keeping of the company, and it may not be very decent. And so for that, what Kamana says is that number one, for every newly incorporated company, for your first financial year, you must meet these qualifying conditions, these 6 conditions we have looked at. But for subsequent financial years, it now gives us 3 variations. Number 1, section 3942. Brilliant, read for us. Yes, my son. 394 sub 2.
Company qualifies as small in relation to a subsequent financial year if the qualifying conditions are met in that year and the preceding financial year.
Good, so that's the first one. If the qualifying conditions are met this year and the preceding financial year, then we say it is a small company. Go to the next B.
Are met in that year and the company qualified as small in relation to the preceding financial year.
Good. Are met in this year, and if the company qualified as small in relation to the preceding financial year. 3. C.
Were met in the preceding financial year and the company qualified as small in relation to that.
Were met in the preceding financial year, and the company qualified as small. In what C is saying to us, confidence, listen. What C is now giving to us as a leeway is that if this year, 2021, all these conditions are met, I mean the conditions that will make us a small company are not met. So let's say turnover now is 140 million. Net assets is now 80 million. Definitely, we wouldn't be called a small company, would we? Because the qualifying conditions have been exceeded. But if the year that just passed, we qualified as a small company, if in 20 what now? 20, we're a small company, then this year will also be called a small company. Yes. If the qualifying conditions were met in the preceding financial year, and the company qualified in relation to that year, it means that this year we mustn't meet. Now, if next year, please listen. So now this year we're a small company. Have the qualifying conditions been met this year?
No.
No. Have they been met this year?
No.
No, because we now have a turnover of 140 million, net assets of 80 million. We are called a small company because of our relation to 2020. So in 2021, we're a small company, but the qualifying conditions were not met. So in 2022, if our turnover is now 160 million, net assets 90 million, we can no longer be called a small company. Why? Because in the preceding year, we were called a small company, which is 2021, but the qualifying conditions were not met. Is something, are you with me? You have to go back and look at it. Even myself, it was technical for me. So if it's technical to anybody here, I perfectly understand. But let me take it through again. Brilliant. Go through it again. A. 3942A. Please listen.
Are met in that year and preceding financial year.
Very easy. The next one.
Are met in that year and the company qualified as small in relation to preceding financial year.
Good. So the qualifying conditions are met in that year and the company qualified as small in relation to the preceding financial year. The next one.
Were met in the preceding financial year and the company qualified as small in relation to that year.
That year. Okay, I think that should be enough. So what am I trying to say? I'm saying that companies are allowed to present modified financial statements if they are small. What do we mean by a modified financial statement? I have told us to look at part 1 of the 6th schedule to the act. Now let's run to audit so that we will not break our head and we'll take all our time on these matters. Audit, quickly, we just run through it, and if your lecturer comes, he takes over. Audit. Now you can look up again. When we're looking at audit now, we're actually looking at external auditors. External auditors. A company can have an internal auditor. Basically, what does the internal auditor do? What does he do? Is to ensure that he maintains a system of financial controls, internal controls, to limit risk, to limit exposure to fraud, and all that. Every system should have some extent of controls. A church, for example, we could say that the senior pastor shouldn't be the one who signs the check. That is a system of control. We could say the vice chancellor and they talk about counter signatories. Is that also? Those are all ways to ensure that we have checks. So the VC will sign, the registrar will sign, the dean will sign, the FO will sign, or one HOD will sign, so that one person cannot wake up and just sign and all that business. So those are all systems of internal what? Internal what? Controls. You go to the bank, for example, to deposit money, and I say, Abadi, please go to the bank and deposit 30,000 naira. There's a possibility that the cashier who is collecting the money can do as though he's punching something in computer. He doesn't punch. He takes the money and pockets it. Is that possible?
Yes.
And Abadi goes home and he tells his sister, I've sent the money. She goes to check, there's nothing. So what systems of internal control will the bank want to put in place? They now first of all bring a notebook. Is that so? Is that so? Then they give him a slip to fill containing 3 counterparts. He fills that slip. The cashier who collects the money stamps. So that stamp from the cashier is a system of internal control. It is evidence to him that the money has been lodged. Thank God we now have alert. So at the alert now is another 4th guarantee. So they stamp it. He enters his name in that book. The amount and the entry into that book is meant to be done under the nose of the cashier. It shouldn't be done there. So it is there. So the cashier ought to see when he has now entered 30,000 naira, he signs. That is evidence. He takes that counterpart slip. When he's going, the cashier takes 1, if I recall. He goes with 2. There's another box. Is that so? There's another box where he drops. So if you don't drop your slip, it's your own problem. But you're meant to drop, is it the pink copy or so? Yes, he drops a copy and he goes. That cashier who took his money, or the teller, doesn't have access to that box. At the end of the day, before the bank closes, that's why your relatives who work in banks always come late. They have to ensure that everything does what at the end? Balances. All that was received and all that we find in that box and all that we have in this notebook, they must balance. If there's no balance, you should raise a query immediately in the first 24 hours. But you know, with all these controls, those who want to do wicked things, they still do wicked things. But the idea is that you're dealing with decent human beings who should be able to abide by these controls. So what am I trying to say? Every system is meant to have some level of internal controls. And for every functional system, we should have an internal auditor who is responsible for ensuring that the system of financial control is functional. Are you with me? Yes. Good people, good lecturer. But in addition to that, for a company and for a number of other such entities, we now have to bring in external auditors. Internally, we will still have an accountant. This internal auditor is most likely to be somebody who is schooled in accounts or finance, but he mustn't be. We'll still have an accountant who prepares most of these documents that the directors are meant to prepare. At the end of everything, the law still says that those accounting documents, those financial statements that have been prepared, should still be subjected to external audit. So these external auditors now come on board to go through all of these documents, ask questions, ascertain them, at the end of which they will now present what they call an auditor's report. And the gamut of this report is to the effect that the statements we have gone through, they give a true, in our opinion, they give a true and fair view of the financials of the company. The role of the external auditor is not to detect fraud. It's not. People always think it is. There's fraud in that company after, and Pricewaterhouse and Coopers audited the account and still gave them a go ahead. No, the people who are to detect fraud are the internal auditors. The external auditor only works with what you give to him. Are you with me so far? So, like I said, their role is to verify these statements and at the end give. So, some things we just want to rush through. Every company, like I said, small companies and companies that have never had business are exempted from complying with audit requirements. But a company involved in banking or insurance, whether it has never done business or not, must comply. But apart from banking, insurance, basically, small companies and companies that have never done business do not necessarily have to comply with audit and requirements. So you see all of that from sections 403 down to about 413. I'll just run through them, like I said, in outline. Thank you, Lord. Thank you, Lord.
Thank you, Father.
So first of all, every company these people are meant to be appointed on an annual basis. You recall when we looked at the ordinary business, brilliant. When we say the agenda is to determine ordinary business, what are we saying?
Saying the agenda is to determine financial statements.
No?
Financial
There are a number of things. A number of items. Number 2.
Declaration of dividends. Appointment of directors.
Good.
Appointment of the audit committee. And disclosure of remuneration of managers.
Is that there? I don't think I can remember that one. No. Appointment. It's okay. You can sit down. So recall. I could ask you in the exam. An agenda has been called. Ordinary business. You should know at your fingertip what is ordinary business. And for ordinary business, you don't need to itemize it. For every other agenda, you must itemize, otherwise you cannot raise it at the meeting. For ordinary business, it is taken by default. Once you say ordinary business, these things are assumed. So, Kama says at every annual general meeting, appoint an auditor. Are you with me? Yes, appoint an auditor. In addition to that, public companies are also to appoint what they call an audit committee. This audit committee must have at least 5 members, 2 of whom must be non-executive directors, 3 of them can be directors or members as the case may be. And the audit committee is to work hand in hand with the auditor and all that. And among the 5 members of the audit committee, 1 of them must be a member of either ICANN, ANAN, or any of these professional accounting bodies. They must all be financially literate, but they mustn't be accountants. But among the 5 of them, 1 must be an accountant who belongs to a professional body like ICANN or ANAN, as the case may be. Is that clear so far? Good. Who may not be an auditor? I'll just run through it. Who may not be an auditor? A person who is indebted to the company. It makes sense. A person who is indebted to the company, or to a company related to the company. If you are owing us, or you are owing a company related to us to the tune of over 500,000, you cannot be our auditor, because of course you cannot be independent. A shareholder of the company or his spouse, a shareholder or spouse of a shareholder of a company whose employees is an officer of the company, so it's a bit technical, a bit complex, but I'll still try and explain. A shareholder or spouse of a shareholder of a company whose employee is an officer of this company. So we have with this ABC Limited, then we have XYZ Limited. We want to audit this company. We want to appoint an auditor. Kama is saying that. So let's assume this company has 2 shareholders, A and B. And shareholder A has an employee in SICAC. Who is also a secretary or director of ABC Limited. Are you with me?
Yes, sir.
Kama says that this man or his wife, Agatha, this man, Alfonso, or is there Agatha here?
No.
Or his wife, Agatha, cannot be an auditor to ABC Limited. The reason is because they have an employee who is an officer of this company. Are you with me?
Yes, sir.
A shareholder or spouse of a shareholder of a company whose employee, Alfonso, a shareholder of this company whose employee in SICAC is an officer, secretary, director, or manager of this company. So it's a little bit complex, but I feel you should still know it. That's why you have paid your school fees. The next one, a person who is or whose partner, employee or employer is responsible for the keeping of the register of holders of the company's directors. So if you are the one holding the company's register of debentures, not directors, register of debentures, you are the one holding it, then you cannot be its auditor. Secondly, your partner cannot be an auditor of that company. Thirdly, your employee cannot be an auditor of that company. I hope that is clear. Are you sure? If you are not clear, say you are not clear. When I was in the university, I went to preach in a class. There was a young girl called Chinwe. She was not known for good deeds in the university. She was not known for what? Good deeds. And I was preaching and giving bad examples with a name called Chinwe. She kept quiet. I said, Chinwe, you're chasing boyfriend. You're chasing boyfriends all over the university. God will judge you. I kept on preaching. Chinwe, leave me alone. And she screamed, leave me alone. Oh, God will help us. I had fun in school. I enjoyed university. Okay. Now let's look at the next one. So a person who is or whose partner, employee or employer is responsible for keeping the register of holders of the company. So we want to audit this company. Kama is saying that if A is responsible for keeping the register of the debentures of this company, A is disqualified. That one makes sense. 2, if B is a partner to A, B is also disqualified. If C is an employee to A, C is disqualified. And if D is the employer to A, D is also disqualified. So 4 group of persons. A person who keeps the register, his partner, his employee, and his employer. These 4 categories of persons cannot be appointed to audit this company, provided this person is in possession of the company's register of debentures. The next one is a person who is an employee to a person who has acted as a consultant to the company for more than 1 year in maintenance of its financial records or has been involved in the preparation of these records. So let me explain again. So A has been responsible for preparing ABC Limited, their financial statements. They engage him as a consultant, accountant, prepare all these our financial documents and all that. B is an employee to A. B is automatically disqualified. So B is an accountant as well, chartered accountant. B is disqualified from auditing ABC Limited because he was an employee to a person who either prepared these financial records or was maintaining them for the company. That makes sense, does it not? Good people. The next one is a body corporate. You cannot appoint a corporate body, a body corporate. Remember, you cannot appoint a body corporate as a director. You recall? Good. You can't. In the same sense, you cannot appoint a body corporate, a corporate entity, like a company or a limited liability partnership or an incorporated trustee. These are all body corporates. You can't appoint them to audit a company, but you can appoint a firm of auditors, a firm that is not incorporated, so a limited partnership 2 or 3 accountants who come together and form a partnership can be appointed, that firm can be appointed to audit a company, provided all the partners in the firm are qualified to audit the company. If one partner is not qualified, then the firm is not qualified. Lastly, officers and servants of the company, as well as their partners and employees, and persons connected to them are also not qualified to audit a company. So for the report, look at section 404. Is to present a report, like I said, to the members, is to lay it to them when the members come for annual general meeting. This is the auditor's report, and it should make report on the company's accounts, balance sheet, profit and loss account, and all that, group financial statement. So see section 404, please. See section 405 for certifications of the CFO and CEO, section 404 and 405. I'll run through it. I'll try and give us a lowdown. I want to believe you will meet it in practice or in law school, those of you that will go into corporate law. So it's a new provision. It was not there under CAMA 1990. The whole idea is that in order to strengthen corporate governance, a number of proposals and recommendations have been made over time. And most of those, or some of them, have now become a part of our law. They were recommendations under what you call a comply or explain regime. I've said that before, have I not? Yes, under what you call a comply or explain regime. There were codes of corporate governance applicable to companies. You mustn't comply, but if you don't comply, explain why. So the code could state that every public company must have a person who is separate from the CEO, and the chairman of the company should be separate. That is what the code says. Now, at the end of the year, you must tell us why you did not comply. Well, we did not comply because we didn't have money to appoint both of them. We did not comply because we were going through a tough financial situation, or we were going through a very delicate time, and we felt that one person alone would be able to take the company through without much confusion and distraction. So you comply or you explain. That is the whole idea of corporate governance. But what CAMA has now done is to take some of those code provisions, and it has now made them a statutory obligation. So every public company now must have an independent director. That is a recommendation of corporate governance. It's now a law. Every public company must have a separate chairman, and is it wise? Not necessarily. One of such recommendations was that the CFO, Chief Financial Officer, and the CEO or the MD should take responsibility for all the financial documents that have been prepared and issued to members. Are you with me so far? Yes, sir. Are you with me so far? Yes, sir. So CAMA is now telling us under section 405 that when these documents have been prepared, the CEO and the CFO, either of them, should now certify that for each, I'll run through them please, because of time, for each audited financial statement, that the officer who signed the statement itself had taken time to review them, and that to the best of his knowledge, A, they do not contain any untrue statements or material facts. B, they do not omit any material fact that would have made them misleading in the light of circumstances under which a statement was made. C, that they fairly present in all material respect the financial condition and results of the operations of the company for the period it covered. D, they will also certify that the officer established and maintained the internal controls for the company, and that he also designed controls in order to ensure that the material information relating to the company and its subsidiaries are made known to him by the other officers of the company. And finally, that he evaluated the effectiveness of the company's internal control system. So please take out time and look at them. There are still 3 of them, but because of my time, I will have to stop now. And then, so we will have to adjourn because I have petroleum law lectures.
And thank you, Lord. Stop it. So we'll meet on Friday, God willing, 8 o'clock in the morning.